the introduction, and nice to see everybody on Zoom this morning, and happy to be at Rainforest Innovations and University of Mexico today, kind of in person. We've been looking forward to kicking off this relationship, and I'm here today and tomorrow, and then we'll be back regularly throughout the year. So looking forward to getting connected into the community here. So the topic that I'm going to cover this morning is around raising capital, and I've kind of deliberately kind of tuned this presentation, if you will, for earlier stages of financing. So hopefully that's the the community that is here today. I'll definitely cover later stages of capital raise, but won't cover it as thoroughly. So just more as a warning. Just a bit about Innosphere. We're a 501c3 technology incubator. We've been working in Colorado for this is our 23rd year, and we also invest in companies through a series of funds that we run. And similar to Rainforest Innovation, we are really a catalyst for helping secure predominantly specialized facilities for technical teams and founders, so wet labs and things like that. So we kind of have three different things we do around commercialization, investment, and then facilities. Cecilia mentioned the collaboration partnership. We're really excited to be, again, in partnership with the university and Rainforest Innovations. So we won't spend a lot of time on that, but we're really thrilled that this partnership was initiated last year, and see lots of really great opportunities coming up in the coming years. So what I wanted to do just to start is give you kind of my sense, if you will, of how companies come together, and then roughly speaking, the stages that they go through, and where different types of capital might be relevant. I think the term startup in kind of the Innosphere world is not exactly a specific term. Every company that comes our way would call themselves a startup. The reality is you may be at a different stage of formation of the business. And so we put this kind of infographic together a while ago to try to help founders more better pinpoint maybe where they are on the continuum. So obviously a company that's just literally starting out may have founders, may have a first technology, and so on, probably are self-funding, grant funding, and then would move into more of a formation stage, and that would be indicative of pre-seed rounds of funding. So you're probably starting to think about angel investment, maybe groups or individuals, maybe there's some revenue. You might be at a proof of concept or an MVP at that point. So I'm going to mainly focus on the stage of formation and what we would call startup. At Innosphere, we call it startup. A company that's probably been around for a while, maybe up to a couple of years, that's already raised some amount of funding, is into some early revenue, and then later stages might our terminology be around launch and scale up, and then ultimately exit. So just to be clear, I'm going to very much focus on this formation and startup stage in the presentation. So let me cover a couple of trends just to help set the stage for what the venture capital ecosystem looks like across the US. And I'm happy to kind of offline go into some more detail on New Mexico in particular, but I think it's helpful just to get the big picture view. Venture capital, really starting in 2018 and moving forward, has literally exploded in the United States. You can see kind of on the chart here, the number of deals is the line, and the amount of capital is the stack bar. So just to give you an order of magnitude, in Colorado, through the end of the second quarter, $3 billion of VC has already been invested to date, just as a data point for one state. Venture just seems to be kind of increasingly growing in the amount of capital that's being put into venture funds. And I want to be clear here, I'm not including private equity. So in kind of the terminology of investment, private equity is a class of investment, and venture capital actually sits inside of private equity, although it is a separate class of investment. So I'm going to really just focus on venture, not private equity here. So you can see, even in 2020, very unique year, we broke, records in terms of venture capital deployment. We will absolutely break the 2020 record this year. There's no question about it here in the Q3. So what's happening within the venture capital world, if you will? When we're working with companies, predominantly they're at what's labeled on this graph that these angel or seed stage, meaning they're a bit earlier. And then the database or the research companies and the databases that collect information on venture generally will break it down into about 3 different categories. The angel seed, meaning early VC, which would generally mean A round, B round, in some data sets up to C, and then later stage would be kind of C round and beyond. And why I just go into that in a little bit of detail here is to really have you zero in on this later stage VC. That's what's very much driving the national venture capital ecosystem, is late stage venture capital investment. And so if you're an entrepreneur and you're working on raising capital, the good news is the amount of funding that's going into the angel seed category is growing, but it's not growing even remotely similar to what's happening at the early and later stage. So you just have to kind of be aware of these trends and where these dollars are flowing in. So what I want to point out, if you look at effectively the middle of the country, that's a bit of a undefined geography, but let's call it kind of off the coast. What you see predominantly is states like New Mexico, Colorado, Nebraska, Oklahoma, North Texas. What you see pretty similar manner is the venture capital that's deployed into companies. For example, in Colorado, what you're seeing the data here, largely the venture capital is coming from out of state. So as we look at 2021, for example, in Colorado through Q2, and similar to 2020, very confident that about 95% of the capital that's deployed in Colorado companies is originated from out of state VC. And why I bring that up is that's not a bad thing necessarily. It just means that if you're out raising funding for your company, you need to be aware of, in a lot of markets, including Colorado and Utah, that there's a relatively limited amount of investment that's actually headquartered in your state that might be more accessible than, say, having to look for investors in Chicago or California or Washington State or so on. So just be aware that that's going on. Last slide on just kind of from a data perspective is something really important to have in the back of your mind, which is when you're raising at the early stage or the seed stage, how much of the company are you likely going to need to sell effectively in the investment process at the early stage? And what you can see in this data is that somewhere between about 22% to about 30% is the average and median. So in other words, when you're doing your seed round, you should expect the investors to acquire effectively, let's call it around 25 to 30% of your business. That is a pretty significant number, and oftentimes that's a surprise to entrepreneurs who are working with it, that it can be that high. Now, I will say that the amount of ownership tends to skew more heavily to the coast, and so you have to be a little bit careful with this data. So that this is national data for the entire U.S. VC ecosystem. So I'm going to switch gears, and hopefully that just high-level orientation was helpful, just to give you kind of an insight into the venture capital world. So when I'm working with companies, really the first question I get them to grapple with is, what type of business are you building? And I would argue that there's basically 3 types of companies you can build, and I'm totally open to your ideas if there's more than 3. The first would be a company that is largely being built to run on an extended basis and really produce economic benefit for the founders of the business over a long period of time. That may oftentimes be called a lifestyle business. I like the term headquarter company because headquarter companies, frankly, create a lot of jobs in the US. And so a headquarters company, there may not be really any exit pathway, meaning that the company is not really intended to be built and sold. Now, the classic examples of headquarter companies to me are family-owned businesses that pass down generation to generation. So why is that important? If you're building a headquarters company, you're less likely to be able to attract outside equity investment because you're not building a company that's being positioned to sell and create a liquidity event for the investor down the road. So that's one style of business. Most people understand the idea of venture-backed, and that just means that a company will pursue angel or venture capital. They're going to try to build a company up that could have a very good exit. If you look at the data, venture-backed companies, median exit is 8 years. It certainly goes beyond that. Just as a data point, companies that are IPOing in the US now, an average time, not median, to IPO is 14 years. Quite a long time, generally speaking, a lot of money to sort of get to that point. So within venture, there are different types of companies you might try to build that are venture-backed. And then the last I want to expose you to is it generally is not well understood, and this is an area that Innosphere has some unique understanding. We think there's really a good pathway for many technology companies to pursue what we call an earlier exit. And that just means that you're building a technology and a company that's specifically targeting an acquisition or a buyout from private equity, and trying to accomplish that in a relatively short time frame. We would say 3 to 5 years from investment, not from when the company's formed. So matters a lot what type of company you're building as you position the business for fundraising. So just want to give you that kind of thought process. So I mentioned when I was prepping for this talk that I would also cover failure points for startup companies. And the good news is there's quite a lot of data out there now, whereas even 5-10 years ago there wasn't as much about the kind of the really significant issues that companies face in the early days that tend to cause them to fail. And on the one hand, we know from a business perspective what the risk factors are, and with a lot of data now, what generally speaking are the most important reasons companies fail. But the other part of the world we live in is for technology companies, there's also and often a lot of technology risks that doesn't show up here. So for example, medical products that need FDA approval. And so just keep in mind that it's very hard to factor in the technical product risk in why a company might fail, but that's certainly a part of it. So let's run through very quickly because this is relevant to the rest of the talk here. The number one reason why companies report being failing is either running out of cash or not being able to raise another round of financing. So think about, hey, I did an angel round and I can't do a seed round, or you did a seed, can't do an A, whatever that process is. My personal opinion is that running out of money or not being able to raise capital, generally speaking, is an indication of other things. And I think the data would also suggest that. And the good news in my mind is that if you look at these core risk factors around companies failing, 3 of these can be mitigated pretty significantly, and those are no market need. So for example, at Rainforest Innovation, there's multiple programs that you can jump into to really help you understand the market need, and really do what I would say is a proper customer discovery process. That mitigates dramatically that risk factor around no market need. Related to that, in the work you do around the market, you should be doing a deep dive into the competitive landscape. Who are the players out there? What are they doing? How do they price the product? How does what I'm doing fit and be positioned against competitors? And oftentimes competitors from a purchasing perspective is doing nothing. So that's a huge part of what you need to factor in. So that generally goes hand in hand with doing a very thorough analysis of the market, is also looking at the competitors. And then lastly, a major risk factor is what's called a flawed business model. And that just means that companies can't seem to find the profit formula that they need to sustain the business through multiple rounds of funding. And where you see that being the most acute is from the seed to A round of financing. And so kind of makes sense in that you might have proof of concept projects, early customers are not maybe paying the full value for what they're consuming from you, and it's very hard to transition into a proper pricing plan and then scaling at volume. So that's the idea around the flawed business model. So what I'm going to cover today is really more around how do you raise money and then position your company through multiple rounds of financing. I think somebody wanted to jump in. Okay, no questions. All right. So as you're thinking about the fundraise process for your company, here are the things I would suggest you start zeroing in on first. And these are intuitive, so they probably aren't foreign to you, but I think literally writing these things down and then working through your answers is a helpful step. So the first question is, how much money do you need? And that's a bit of a deceptive question, because most companies that I've worked with personally over the years, particularly in the early rounds of funding, I'd say almost always overshoot how much money they require, meaning that they think they need to raise a lot more money than they do. That's not always the case, but very often the case. The second relates to how much money do I need? And that is, if I'm in a seed round of funding, how much do I need to raise? And what specific business milestone or product milestone can I hit that's meaningful, that will add value and get people excited about funding the company to the next round? Most pitches I see are very unclear on that point. So I'd encourage you to really think that through. So in other words, I need $500,000 to complete animal work for a medical product. I need to start pre-submission FDA, and I need to do XYZ. Those are milestones. Next question for many technical founders is a tough one, because your organic networks don't include a lot of investors. But how will I find prospective investors? And so this kind of gets back to some of the data I showed you earlier. Depending on your market, you may exhaust very rapidly the local investors in your network. And so for most technology companies that are raising capital in the middle of the US, you pretty much have to start looking out of your home market pretty quickly. And so you'll need to have a process to identify and start interfacing with investors that are not in your region. And that's a skill set that is gained over time that you also can get quite a lot of help with from Rainforest Innovations. The next is, as you're preparing your materials and you're building your deck, I would highly encourage you to identify and then figure out how to communicate what you believe at the time to be the key risk factors in the company. So for example, a key risk factor might be, I don't have a complete team, but here's how I've mitigated that. One of the things that's quite frustrating for investors is to hear a pitch from an entrepreneur that's just very optimistic on all fronts. And then they have to do quite a lot of work to try to discover, well, where are the real risk factors? Is it technology risk? Is it team risk? Is it the ability of this company to raise, in a lot of cases, significant capital over time to actually be successful, and so on? There's multiple examples of that. The next point is more to get you into the mindset of the investor. So when you're particularly pitching individuals that are high net worth, keep in mind that they're likely getting all kinds of investment opportunities coming their way from their network, from their wealth advisor, and so on. And you need to understand how a direct investment in a technology company stacks up against how might I view leaving the bulk of my wealth in the market right now, or how do you compete with a real estate project that may have been brought to them, or so on and so forth. And one of the best ways you can get some of this insight is to do some research in the wealth management or wealth advising sector, get on some free newsletters, and just see what kinds of advice are being given to high net worth individuals that are angels, to see, well, what are all the alternatives that are likely that are out there for people, and then how does my deal sort of look to them. Now, if you're dealing with family offices, and I'll define that here in just a minute, or an institutional investor or VC, you're really competing with a different set of investment opportunities. Family offices are going to look more similar to high net worth individuals, just on a larger basis, meaning more capital. VC and private equity firms, angels, you're going to be competing with all the other deal flow that they may be seeing, so slightly different. And then the last question is, what do you think the basic structure of the investment looks like, and what are the terms? And starting to think about that, work about that earlier on. So now I'm going to transition, I'd say, more to the tactical part of the presentation, which is as you're getting out into the fundraise process, who am I going to go talk to, and sort of when am I going to talk to these folks? So just loosely defined, and there's unfortunately no exact definition for these things. Earlier investors, particularly angels and individuals, are going to take on a lot more risk, and are going to see lower pre-money valuations, and are going to generally put less money in. Again, generalization. As you keep moving, what you should see as a company is progressing is my valuation is going up, becomes more clear how much capital I need to build the business. You can get confident in larger investments, and for the founders in particular and early investors, there's more and more dilution every step you take into the funding process from seed to A to B. And so at a high level, you ought to understand the venture math, if you will, around how this works. So for example, there's multiple models that you can get access to that are free, that help you effectively model out over a period of time, how does the ownership work from the founder's perspective in particular, under different assumptions of how much capital do I raise and what's the valuation of my business, and then modeling that over a series of financings. And what that will show you is very clearly this dilution issue that you're gonna have as a founder as you raise more money, but also should give you some guardrails to think about how much money to raise at different stages, so that you're managing the dilution as best as possible for the founding team. So pre-seed funding, let me define that just quickly. This would be the first, what I would call professional money, or professional investors you're dealing with. Probably angels. They may not call themselves angels, they may be individuals that are high net worth that invest in companies and do it directly, and probably don't do it necessarily through an angel group per se. Generally speaking, you're talking about relatively small amounts of money, probably up to 250,000. They certainly can go up and down from there. Once you get beyond a pre-seed funding, then you're going to get into what's more widely understood as a seed round. And in the middle of the country, I would say, generally speaking, what we see is seed rounds of 1.5 million to probably around 2.5 million. Generally speaking, not much higher than 2.5, and certainly can be lower than 1.5. So they're kind of all over the board. But who invests at the seed stage? Super angels. These are individuals that write bigger checks. Angel groups, family offices, micro VCs. And so that's the target group at the seed stage that you would be looking for when you're raising money at that level. And then the venture capital community is it's a more widely understood from entrepreneurs because that's what we read about and hear about every day. The VCs, generally speaking, are going to do later rounds of funding, and an A round these days is 4 to 5 million. Certainly, again, could be plus or minus a bit here. And then later stage, you're into a whole different set of asset classes, private equity, corporate venture capital, and so on. So again, I'm going to focus in on the pre-seed and seed funding mostly this morning. So let's start with angels. First thing you need to know, if you've not gone out and raised capitals, you need to be aware of something called an accreditation. And if you're working with angel groups, meaning like New Mexico Angels, all those folks are accredited. You need to more worry about individuals that you might be pitching. Make sure that you should ask them for credit, and if they don't know what you're talking about, that's probably a good sign you might not want to keep pursuing. You do need to take the responsibility to make sure your investors are accredited, and that's defined by the SEC. So first off, know that. Secondly, angels, particularly in the early stage, are really important to a company in a variety of ways. Access to time, and a lot of these folks are very experienced entrepreneurs or business folks. And so they'll oftentimes not only write a check, but help. They might join your advisory board. You might put them on the board themselves. They also usually have great networks, and individual angels, angel groups, they certainly will help you fill out an investment round. So think of angels as, time, talent, treasure. That's what, it's kind of called in our business. Not just, hey, I'm going to write a check and sort of be gone. Let me walk through the angel group process, and I want to be very careful here. I'm not describing any one individual group, but generally speaking, the process that you likely will experience once you apply to an angel group. So the first thing you need to know is you can't just kind of show up at an angel group and pitch. That's not how that works. Every angel group subscribes to a platform. AngelList, Seed Invest, or Gus. Those are the most popular, not famous, popular ones. So, for example, you go to the website of the New Mexico Angels. I'm pretty sure they're on Gus. I'm not 100% sure. Maybe someone can tell me. And so, if they are, then if you want to pitch those folks, you got to go to Gus and put a profile together. While you're at it, you might as well do a little bit of research with other angel groups that are in your region. See what platforms you're on and go ahead and do one or two at the same time. It's a little bit easier. Within a Gust or a Seed Invest AngelList, what you're doing is setting a profile up for the company, and it's a platform for sharing documents and actually applying to angel groups. So a very important part of the first step, you have to get there. Once you apply, and keep in mind, most angel groups are seeing hundreds, if not thousands, of deals a year. So there's a lot coming in. There's a screening committee that looks at everything that comes in through the portal, through Augusta or AngelList or whatever. And they're going to pick through the myriad opportunities and deals, the best ones that they like to actually pitch to the group. So keep in mind, once you apply, to the time you've been screened to the time you actually pitch, probably is 2 to 3 months. And why is this? Most angel groups are volunteer based, and they might have some professional management, if you will, but they meet infrequently, meaning typically once a month, maybe twice a month. And so because of the amount of deal flow they're getting, they generally schedule out 2 to 3 months the companies that are coming in to present. So you should expect, again, from the time you start to, if you're selected to pitch, could be up to 3 months, hopefully shorter. Now, what happens when you come in and pitch the group? The most important thing that has to happen is a member of the angel group has to identify themselves as having a high level of interest in your opportunity, and that they will lead the investment on behalf of the angel group. So that leading just means they're going to help coordinate with the diligence committee, the work that needs to be done. They're going to be your primary contact, but they're an individual or a couple that have a high level of interest. That does not mean the group's going to invest. It just means you move on in the process. So once you take that next step, and this is where different angel groups are going to be different, so I want to be cautious. Many angel groups will, at that point, establish basic terms that they're thinking at that point in a term sheet. Some might go into diligence and work on a term sheet later, just kind of depends. The term sheet is going to outline how much do we think the group can invest, and then what are the terms. And the key terms, will be outlined in either a convertible note, almost always with angel groups, or if it's a larger angel round, you might go through what's called a priced round, which means you're setting a pre-money valuation. So there's a lot of detail within all that, but just keep in mind there's kind of two paths. Most angel groups are going to go down the convertible note route, and so the key terms that will be in a note will be how much money are they likely to invest, what's a cap, that is an informal, I would call it, valuation for the company, and then what's called a discount rate, which is usually 6 or 8%. So those are kind of the key terms. Now, let's say that in the case of this angel group, fictitious angel group, that they go through a term sheet process, you sign off on that with them, then you go into due diligence. You should expect a month to 2 in due diligence, and it will be a lot. Most angel groups have a pretty thorough checklist they send you of all the materials they want to look at, and they will do a thorough review of all that material. So after that process, then the angel group comes down to a yes/no decision on the investment. And you're sort of not done there, because angel groups are made up of individuals who invest individually in a deal. And so you can oftentimes see an angel group get to a yes on an investment, but may have relatively low participation from the members in the deal. So in other words, if the target was to raise 500,000 from that angel group, and you only may actually see 200,000. So what happens at that point, terms are set around when they would close their part of the financing, but most angel groups are very helpful in doing what's called a syndication. That just means finding other investors to fill out the round to that 500,000. So your angel should help you, in other words, close out that round if they can't do the full amount. So bottom line, end to end, I would think about 6 to 9 months in the process of working with angel groups. And so you have to factor that in your timeline. So family offices are going to be much less relevant for early stage companies, but I want to talk about them briefly because the term gets thrown around and oftentimes not widely understood. So a family office is really just a wealth management function, and it's oftentimes provided by an advisory firm. So in other words, if you have a high net worth family or individuals, they're probably not managing their own money. And so the function of managing the wealth for a family is a family office. And there's 2 types of family offices. There's a single family office. That just means, hey, it's X family. Or definitely getting more and more common, you have wealth managers that run money for multiple families under one umbrella. So you have to kind of understand the difference. These are, again, generalizations. Most family offices will not lead deals, either seed or A. Some will, but most will not. You can't just Google family offices and get a list of them. There's no such list. Many family offices very deliberately keep a below the radar profile. So they may not even have a website, or if they do, it's gonna be very basic and it won't tell you a whole lot. So you need help getting introduced to family offices, and the best way to do that is through your lead investor, who probably already has relationships with family offices in your region that like to see venture capital or angel-led deals, and they'll evaluate those, but they are probably very unlikely to take meetings with you personally to hear your pitch. So you need help with an introduction. Family offices, by and large, look like VCs, meaning that they can write fairly substantial checks and can also follow deeply into future rounds of financing, meaning like A, B, C, D kind of things. So they can be a very, very important part of your strategy for raising capital, but they're probably less relevant for you in the early days. Probably the most relevant VC for many companies and I want to define this term, are micro VCs. And so, for example, Innosphere Ventures is a micro VC. These are professionally managed funds. They are venture capital funds. They just tend to be smaller. They tend to have very specific focus areas in an industry or a geography. The smaller firms tend to be very kind of driven from a personality standpoint by the founders, because these are small teams. Almost all venture capital funds are 10-year. So, for example, if you're pitching a VC, you ought to know if they're a micro VC or a larger fund, and then you ought to understand very early on where are they in the cycle of their fund. So, for example, our new fund is in the first year of investment, meaning we're going to actively invest for the next 5 years. So, if you're pitching funds that are in 8-year, 8, 9 of the fund, it's very unlikely you're going to get a new investment. So you're not going to get a new investment out of those funds that are later, that are at the tail end of their life. In fact, many funds can't invest in the out years, including ours. We cannot invest beyond year 6. So why would a VC be meeting with you if they're running a fund that's 8 or 9 years old? They're probably working on next fund or looking for new investments. So yeah, you need to ask that question. And then lastly, very important to understand from the general partners, that just means the people that run the fund, what size investment they're doing. So for example, I'm aware of numerous micro venture capital funds that actually invest like large funds, meaning they do large checks at the A round and then target a B investment. And so what their strategy is, a relatively few number of companies with a high concentration of capital in them in their portfolio, versus like an Innosphere fund, we're looking for 25 primary investments and about half follow on. So a very different style, and so therefore leads to different investment amounts. So micro VC is not a defined term in terms of how much capital under management technically, is in a micro VC. Some people would say it's 75 million. Some people say it's 100. I don't know what the number is. I think it's around 50. There's lots and lots of funds below 50 million in the US. So venture capital then, hopefully in this explanation you're hearing, really there's kind of two different flavors. There's smaller funds, there's larger funds, and then there's very, very large funds. They're all quite different. So I'm going to kind of cover the middle ground here. Funds that are, let's say, 75 to 250 million are, generally speaking, the types of funds that seed and A round companies go to. And kind of the big thing to know in venture is that most A round investors want to see a lot of traction in the company before they invest. So in software, just to give you kind of a rule of thumb, an A round software VC probably likely would not even consider investment at the A round unless your company had $1 million of recurring revenue, not one time, meaning proof of concept, but recurring revenue. So for most software companies, which are a bit easier to build than, let's say, an advanced materials company, it can take a couple of years to get to $1 million in revenue, just to give you, kind of a time frame. So same thing in the larger funds. You need to understand the focus area. What's the style of the management team? Where are they in their fund? These funds are 10 years as well. And then same question around size of investment, critical question. And I won't cover this extensively, but many companies are attracting corporate venture capital these days. And just a data point for you, in 2019, 2020, we don't have good data year to date, but I suspect it's the same. 25% of the venture capital that's deployed in the US is from a corporate source, meaning it's either a corporate venture capital fund, that just means like Bayer puts a VC fund together, and it's Bayer Ventures or whatever it might be called, or a corporate might invest what's called off the balance sheet. So if you're aware of like Koch Industries, for example, in Wichita, very prolific tech investor, a little bit later stage, they're actually not a fund, but every time they invest, they are corporate venture capital. So that's just flavor of corporate venture capital. Corporate venture tends to be later in the process, not always, but generally. And you can see all kinds of structures in corporate funds, balance sheet. You can see, arm's length VCs where they are capitalized by the business, but the actual parent company is not involved in investment decisions, are all over the map. So just keep in mind as you get probably close to the A and beyond your A round of funding, you ought to be thinking about corporate venture as an option for the company. So last slide, and then I'll open it up for questions. These are probably the top kind of challenge areas, I'd say, for companies that Innosphere has worked with over the years around raising money. So the first is having an unrealistic time frame of how long it's going to take to raise money, both at seed and A in particular. Second is companies very much believing they're ready to raise money, but there are kind of holes in the pitch and the story and the investment opportunity, and they're not self-aware of what these problems are. And so they keep pitching, and the investors are not necessarily probably not going to give you a lot of feedback. And so they kind of keep going. The third is, and this is kind of an interesting one for me because we work with lots and lots of really smart technical founders that have deep domain expertise and are excellent researchers in their own right, but not spending a whole lot of time trying to understand what's going on in the investment universe. What are the trends in VCs? What are valuations in my region? What are, kind of air quotes, standard terms and notes? And because they don't do that work, they run into the wall because they have not, put the effort into really building out an investor network that ultimately will fund the business. And then lastly, and this is an increasingly big problem in my world, is companies really not understanding, equity funding and the economics around it, and just proposing valuations in terms that I would say are not standard, meaning they would be very much unexpected in our marketplace, maybe expected in Silicon Valley, but not in Denver. So these are the kind of the four big ones that as companies get out and start raising money that tend to trip companies up. So